GM, I'm Hikaru, and today I'm going to be doing a series on why Bitcoin is not just another asset, what it actually trades on, and everything about liquidity. Everyone's drawing lines on charts, they're looking at support levels, RSI, moving averages, and honestly, most of the time it's just noise, right? If you want to actually understand why Bitcoin pumps or dumps, you have to stop looking at the asset and start looking at the money that buys the asset, okay? Today we're going to be talking about the plumbing of the financial system. We're talking about global liquidity, and I'm going to show you why Bitcoin is not just another asset, it's a smoke alarm, so to speak. And right now the smoke is getting thick, so let's look at the charts. This is global M2. Think of it as the tide. When the tide comes in, everything rises, from stocks, gold, crypto, and the world has roughly $350 trillion in debt. We never actually pay it off. We just roll it over. Okay, we basically get a new credit card to pay off the old one. Every 5 to 6 years, a new wall of debt comes due. To stop the system from collapsing, central banks have to inject liquidity to help refinance the debt. This is the heartbeat of the market, not earnings, not tech adoption, just the necessity of keeping that Ponzi going. Now look at this lower chart. Now look at this. This is the M2 deviation indicator I've made, where it's actually just tracking the deviation between the current chart and M2. So we're actually getting a pretty good indication of where Bitcoin is just deviated from M2, and we gotta look out for bear markets or bull markets, right? Around here from there, it's actually a pretty good indication of a full bear market. We're actually kind of inside one. I mean, it's pretty oversold, so we might just bounce from here, but it basically gave us a sort of bear market indication right around here, right? So everything from this point until here was categorized as a bull market, which it's actually quite encouraging if we indeed are getting some pretty oversold conditions here. If we actually go back to here, yep, we got some very reliable oversold conditions here, which actually this period here, the FTX collapse, I think, was a moment where the market very much deviated from global liquidity and other assets like stocks. We actually saw a pretty solid market reset here. This moment was basically the bottom, liquidity wise, correlation wise. This was just a very intense hiccup the market got due to the FTX collapse. So as we can see, if we actually just zoom out, this M2 indicator is actually forwarded by around 13 weeks or so. Global liquidity does have an offset impact on the markets. It's not immediate. However, we do see there's actually a very interesting thing going on here where Bitcoin tops a lot earlier. Why? Because Bitcoin is the most sensitive asset in the world. It's the canary in the coal mine, so to speak. When central banks just start thinking about easing, Bitcoin moves. When they start thinking about tightening, Bitcoin crashes. So this gap here is pretty important to see whether or not the tide has moved relative to where global liquidity is doing right now. But where does money come from? It's not just the Fed. Let's check out Fed net liquidity. This takes the Fed's balance sheet, subtracts the Treasury General Account, and adds back the reverse repo. As far as I understand, here's the alpha. Even when the Fed says they're tightening, the US Treasury can inject money by draining their checking account or issuing short-term bills. This is actually called stealth QE, which has been happening for a while. The government is forcing liquidity into the system because they cannot afford a recession with this much debt. So this is what is actually causing the correlation between the Fed net liquidity and Bitcoin chart. And here's the inverse DXY, which is the dollar index just flipped upside down, which almost looks very much identical to the M2 global liquidity just detrended, so to speak, right? When the dollar gets diluted, asset prices denominated in dollars, of course, go up. It's not that your Bitcoin or assets are worth more, it's just that the measuring stick, which is the dollar in this case, is shrinking. Just as M2, the inverse DXY affects asset markets after a pretty solid 90 days or so. Although the correlation between the impact is more of a normal distribution like this, where the top impact is around 90 days or so. We gotta get like 65 days of an impact or 130 or so. It actually just depends, okay? There is one thing that kills liquidity: volatility. This is the move index. I just put it in inverse, right? 1 divided by move. This measures the volatility in the bond market. Think of it as the VIX, but for treasuries, okay? Here's the rule. If the move index is high, liquidity is broken. Okay, so we actually, well, this is the inverse, but normal move, you want it to go down, of course. Our entire financial system is built using US treasuries as collateral. Sort of like a pawn shop, okay? If the price of the pawn, which is the bond in this case, is bouncing around wildly, the lenders get scared. They stop lending and liquidity just dries out. So, we should actually watch this like a hawk, okay? We need the move index to crash down, in this case go up since it's inverted, because stable bonds mean higher liquidity, which just means higher for crypto, okay? And do not ignore the East, so to speak. This is the Chinese liquidity proxy. China is fighting its own battle. They're trying to devaluate the yuan, not against the dollar, but against the real stuff. We actually have a sort of liquidity proxy here, which has a pretty good correlation. We also have another chart, which are Chinese liquidity injections. We gotta keep in mind that there are so many charts out there that are important, but if it doesn't yield any correlation with the Bitcoin, you might just toss it away, okay? This, you have to understand that a lot of charts just you don't need to understand them at all. You just need to find that correlation and find your edge to it, okay? In this case, we're getting these peaks and these drops, and we actually just want to weaponize it and have it in our tools, okay? So if this is up, our indicators are up, macro is up, and this is just very high confidence, okay? Gold. This is why gold is hitting all-time highs. It's not fear, it's just monetary inflation. Gold is the anchor. It tells us how much the currency has actually been debased. Think of it as gold is a safe play on currency debasement, and Bitcoin is just a leverage play on the same thing. They're sort of teammates in the capital wars, as we should say, against fiat currency. So one important chart to take a good look at would basically be the Bitcoin gold ratio. If BTC and gold are basically hedges of currency debasement, then we should actually rotate between them, okay? So right now, of course, the winner is obvious. Gold is a winner. As of right now, BTC has lost a lot of ground against gold. So let's actually see a indicator for BTC and gold. Okay, so on a binary basis, of course, gold is winning by quite a lot. It's actually so oversold that BTC might just bounce. We don't know. There's actually something pretty interesting that, right now I'm going off the deep end, but if you get any valuation indicator, you're getting a lot of oversold conditions here. I would not trust valuation indicators on ratio charts, because right now gold is sort of going on a pretty good bull run. So, and BTC is having a lot of weakness. So this is actually just a ridiculously short sort of situation going on. So this is pretty good for catching trends. Okay, just catch the trend of BTC against gold. But if you actually want to just have a pretty solid foundation on oversold conditions, then just use the nominal chart. You might just get pretty false signals, maybe here, right? A lot of a pretty fast cooldown that happens between the ratios here. So keep that in mind. So to wrap this up, we're heading into a massive debt maturity wall between 2026 and 2029. So that's trillions and trillions of dollars that need to be refinanced. So the government has two choices. Okay, so they either let the system collapse or print the money to facilitate the rollover. They will always choose option two. They always choose option two. This is called fiscal dominance. So BTC isn't just a tech stock, it is actually a call option on the failure of the fiat debt system. The more liquidity they pump to save the bonds, the higher the Bitcoin chart goes. So don't fight the Fed, and definitely don't fight the debt cycle. That's it for this lesson. Thank you for watching.